Welcome to the Buffered ETF guys. Bear markets happen, but so do bull markets. So why not be prepared for both? Buffered funds offer some downside protection and some upside growth potential. They're like ETFs with airbags so that you can get retired, stay retired, and stop stressing over the next market crash. All content is for information purposes only and should not be relied upon as individual advice. Investing always involves risk and possible loss of capital. All opinions expressed herein are solely the opinions of the person making them. Participants and clients of ATX Financial Planning and guests of this podcast may maintain positions in the securities discussed in this podcast. Talk to your advisor before acting on anything. Nothing mentioned on this podcast, including specific investments mentioned, should be taken as a recommendation. Advisory services are offered through ATX Financial Planning, LLC, an SEC registered investment advisor. All right, welcome back. We are on a new episode of the Buffered ETF guys. Welcome back. We've got myself, Mike. We've got Dallan over here.
Hello, hello.
Hello, hello. And we've got Jack Nussbaum joining again. He was a guest on our last podcast as well. We're going to continue that here, talking about dual directional ETFs. But before we get started, Jack, how many children do you have?
I have one. Our second's on the way in September.
Oh, that's incredible.
Congratulations.
What's the due date?
Thank you. September 7th, 2 days before my lovely wife's 31st birthday.
Awesome. And that is...
Oh, bold. He stated the age. That's
yes.
bold. Huh?
2 days after my birthday, and I will be 51.
Oh, there you go.
So I know the difference between your wife and my age now. So has your 2-year-old done anything crazy lately?
He does everything crazy. He's a ball of joy, but he's just entering that age where it's just full-fledged chaos.
Yes.
Thankfully I get to go to the office and get a break. My wife's been a rock star with handling him, but no, he's fun. He's just obsessed with trucks and trains. Our innovator office here is right next to the train tracks in downtown Wheaton. So every morning she'll take a stroll with him and he can just sit and watch trains for hours and hours and hours. And so we're big proponents on trying to limit screen time for him at this point in his life.
Smart.
But the one that there's a YouTube video. It's about an hour straight of trains, just videos of trains.
Yep.
And he can sit and watch that. And we don't feel as guilty because it's just a video of a train. And so, we had to childproof all the cabinets. So he's a full menace right now, but it's cute and it's fun. We're loving this stage of life.
Beautiful. My 3-year-old just turned 3 last week. And at 1 a.m. last night, I was awoken to go look at him eating at a little kid table in our dining room with a bowl full, not a glass full, but a bowl full of orange juice. He pulled the entire jug of orange juice in his bowl, overflowed it, tried to carry it to the table, spilled everywhere, and had an entire package of turkey lunch meat out. And he just looked at me like, "Hey, Dad, what's up?" And then he said, "Is it morning?"
That's what I have to look forward to. Yeah.
I said, "No, it's not morning. Dad's got to get up in a couple hours." And Don, you've got a new little grandbaby that's tiny.
Yes. 5 months now.
Ooh.
Yeah. So,
Love it.
Yeah. 2.5 and 5 months. 2.5 years and 5 months. So I'm you all have to deal with that on a daily basis. And
you get all the fun parts.
Yeah, I get the fun, give them to me, spoil them when they, aren't happy or whatever. I just hand them right back and we can go on our way. I'm not above giving sugar,
red dye.
Yeah.
Different time. I love it. Awesome.
Yeah.
Well, let's get on to dual directional ETFs. I don't know how y'all come up with these names, but they're fun and fascinating. And I don't know if y'all do it to confuse advisors or make them think y'all are the smartest guys in the room, or just be like, "You said what? Say that again." Yeah. So tell us what dual directional buffered ETFs are.
Yeah, so we're excited for these dual directional buffer ETFs. I know it's a mouthful, but the nice thing is for a lot of folks that either have familiarity with buffer ETFs, there's just a little bit of a wrinkle in them. And if we look at I know we've said a lot, but the structured note space, annuity space, we kind of use that as a guide map here at Innovator. That's the whole goal with defined outcome, is trying to give clients a structured outcome in an ETF wrapper that has a couple benefits tied to it. And within the structured note community, dual directional featured notes are a pretty popular lineup because they offer a unique payout profile and the fact that they can actually deliver positive returns for clients, even in negative markets. All right. And so if we think about how a regular buffer ETF operates, all right, for example, a 15% buffer, let's use an example that runs a year. And let's say hypothetically, this thing has a 13% cap on the upside. With a traditional buffer ETF, you're participating 1-to-1 with the market and you get capped out at 13. So as the market goes above 13, that's your max. But then on the downside, more importantly, it's protecting you. The fund will be flat until the market drops greater than 15% on the downside. So you have this built-in 15% buffer. You only start experiencing losses greater than the fee past when the market goes down past 15%. What these dual directional buffer ETFs are going to offer is an added feature. We're going to have a 15% buffer version and a 10% buffer version, in which you actually, if the market finishes in that buffer window, you will get the inverse return of whatever the market does. All right. So let's slow that down. So say with a 15% buffer example, again, market goes down 16%, you're down 1, right? Because it's past that 15% buffer window. But anything from 0 to negative 15 on the downside at the end of the year, you will get the opposite. So the market's down 10, you'd be up 10. Market's down 12, you're up 12, so on and so forth. Then you still have the benefits on the upside of participating 1-to-1 up to a cap on the upside. Now, the trade-off, because just like anything else in our industry, we all know it. You can't have your cake and eat it too. There's always a trade-off with these things. The trade-off with a dual directional buffer compared to a traditional growth buffer is your upside cap is going to come down a little bit. So instead of a 15% buffer that might have a 13% cap on the upside, like I used as a starting example, this same 15% buffer, your cap might be, call it 9 or 10%. So that's the trade-off. But the power in these and what we're excited for is first thing in our lineup really that will be able to deliver, uncorrelated returns, deliver positive returns for clients, even in negative markets. That's exposure that's really hard to find typically. So we're excited to have it in a defined outcome vehicle that, again, before you invest, here's our upside, here's our downside protection, and here's this inverse window in which we'll get the, inverse return of the market.
Love it. So go ahead.
Oh, I was just going to say, so this is very innovative, coming from Innovator ETFs, and
I think I have one of those.
Yep, living. So very on brand. As you've launched this, how are you guiding advisors or investors to use a product like this? Where does it fit in their portfolio? Because people have their portfolio set down, and okay, here comes this new product. This sounds really interesting. How should I think about using this in my portfolio?
Yeah, I think that's a great question, Dallan. And what's nice with defined outcome ETFs in general is it's not necessarily a one size fits all. There's different exposures that are designed to be used in different parts of the portfolio. And, it's all about it, trying to get to a client's return objective. And for some, that means this buffer might fit here, while others, it might fit somewhere else. There's no right or wrong way. And our whole goal with these types of products at Innovator is to give resources for groups like you all to make educated decisions of here's this client situation and here's the best way that we can go about achieving these return goals, right? Now, with that said, there's probably a couple obvious examples of where you'd use a dual directional buffer. It's going to be first and foremost just kind of like a hedged equity approach, a way to take some equity risk off the table. You have a 15% not only buffer but an inverse buffer on the downside, and you still can get some good amount of upside. Again, 9 to 10% with the 15% buffer, a little bit higher cap with that 10% buffer version, and so it just kind of widens your outcome, the chances for you to make money across different market cycles. So hedged equity, I think we'll see that's kind of the main opportunity where I think a lot of advisors will consider a strategy like this. Outside of that, I think we'll see a lot of folks, and this is feedback we've received so far, is using it as a potential bond complement or a fixed income complement. All right. You historically own fixed income in a portfolio for two reasons: for income and for protection. What's important to note with these, and is the case with most defined outcome or buffer strategies, is there's no income being kicked out. This is a growth play, but depending on the amount of protection, you can throw it in a fixed income bucket because you got the protection, but more importantly, you have the ability to have some sort of inverse or uncorrelated return, even if the markets drop. The whole point of a 60-40 portfolio is when the 60 goes down, we hope that the 40 either stays flat, maybe goes down a little bit less, maybe it goes up. Last 5 years we've seen quite hasn't panned out as far as fixed income holding up well. So I think when you have an inverse buffer, now you're talking something that, all right, market goes down 15, we actually can make 15 for a client, even if the equity markets are down. And so as an uncorrelated, hedge, risk management diversifier, I think we'll see a lot of people use these as a fixed income complement too.
Two concepts that came to my mind while y'all were talking are correlation and rebalancing, where someone may say, hey, we're throwing this in there with a couple of these other things, and they'll perform in different markets where maybe investment A goes up well in this market and investment B does this and investment C. But if they push and pull, you're kind of maybe reducing some of that downside risk, which could help with that lower correlation and could help with some of that rebalancing when in certain markets. So it's not that there's the perfect investment out there, right? Even a great investment with quote unquote great with a long-term track record, if it goes down really bad and you're in drawdown mode because you're in retirement or something, that could be really different than someone who's just still going to continue to hold on to it. And so different strokes for different folks, different risk tolerance, different times in their life, right? You could have someone who their whole life has been aggressive, then they get near retirement or in retirement and they go through just this recent tariff thing and say, hey, I can't handle the risk that I thought I could. And I want to de-risk. I want to downsize my risk. I want to move from this risk tolerance to this lower one. I want to insert some more ETFs and funds like this that really help me focus on some of that downside protection. It's kind of like golfing where I could just go out with the driver and just hit the driver, no other clubs. And I could probably hit it, 500, 600 yards drive? What do you think, Dallan?
This is what I have to put up with every day, Jack.
All right, so it goes 125 yards. But if I hit it wrong, it can get really bad quickly. But if I only went out with a putter, I'm probably going to stay in the fairway and get to the green, but it's going to take me 20 strokes to get there every time, and I'm not going to score well. So we've got all these in-between clubs, a 5-iron and a 9-iron and a wedge and all these, 8-degree and whatever all the super utility terms are. And that's really where we are in the ETF world, right? You don't just have to have all investments that go fast or all investments that go slow. There's different things that different clients can choose from.
No doubt. And that's what's nice with, as these dual directionals now come into the space, we just have an ever-growing menu of options. And it's all about, what is the appropriate risk tolerance for you to, again, achieve what we're trying to achieve. And I think these dual directionals just add another layer of, back to your golf analogy, Mike, with these, you're going to eliminate the bad snap hooks where they're going off the out of bounds. You have to take a drop, right? But you're also sacrificing, got a cap on the upside. You're sacrificing the ability to maybe drive the green on that short par 4, right? But you're out there in the fairway, you're playing offense, you're clipping away, getting to your goal. And so even with these dual directionals, we've ran a lot of back testing here at Innovator to determine, what's the appropriate buffer amount and how can we help set expectations for advisors? And with a 15% buffer, if you take a rolling 1-year period going back to the 1950s, 95% of markets, you will deliver a positive return for a client. That's a pretty powerful stat. If you think about
these
that's pretty
dual
much
directional,
just saying, with the 15% buffer example, that's pretty much just saying in all markets, rolling 1-year periods, 95% of them were within negative 15 or less or positive, right? And so being able to just have this tool that, and even in those 5% where the markets dropped greater than 15, we're still only 1-to-1 with any of those losses past it.
And what reference asset are you using for that one? The S&P?
S&P 500. Yep. So both are dual directionals. The 15 inverse buffer and the 10 inverse buffer are both going to be tied to the S&P 500 to start, and they will run a 1-year outcome period.
Okay. So one of my best friends and my pastor out in California, he's actually the one who ordained me. He says, tell them what you're going to tell them. tell them what you told them. So I'm going to kind of reiterate or reapply what you said about the dual directional, and I'm going to run it with 3 examples, and you correct me where I'm wrong or if I'm wrong. And I'll also set this up to say that Innovator ETFs, we appreciate Jack being on the call. We don't endorse them. They don't endorse us. We do use some of their funds. We also use other companies' funds. Where we talk about caps and downsides, they are gross of fees, meaning they're not the number. If we throw out any numbers, it's not net of fee, not net of ETF fees, not net of our advisory fees, anything like that. So take that for what it is. And I'll just run 3 examples. Let's say someone bought a just ETF, no upside, unlimited upside, unlimited downside, of course, down to 100%. And then we've got a traditional 15% buffer ETF where they have a cap, let's say 13%, an example you used a minute ago, so they can make up to 13%, but they're protected on the first 15% of losses, and they only are responsible for the losses beyond 15% over that 1-year outcome period. And this third ETF, which is this new dual directional buffer ETF, which the cap is not as high as A or B. It's, let's call it 10%, but you still have the 15% downside protection like the B. But if you actually fall between the 0 and 15, you actually get the inverse of that return. You actually don't lose, but you make money. So if the market were up 20% on the one with no cap, you'd make 20%. On the traditional 15% buffer, you'd get capped at, say, 13% gross of fees. And this new dual directional, you get capped at, say, 10% gross of fees. Now, if the market was down 15% on the first investment, you'd be down 15%. On the second traditional buffer ETF, you don't have any losses because you're protected on that first 15% in our hypothetical example. And the third one, if you're down 15%, you actually make the inverse of that. So you turn the negative into a positive. You actually make a 15% positive return. Now, if the market's down 20% on investment A in our hypothetical example, you'd be down 20. On investment B, the kind of the traditional 15% buffer, you'd be down 5% because it's the 20% down, but you're protected on the first 15. And then this new dual directional ETF, we'll call it investment C, you're down 5% similarly because you got the 20% less the 15% buffer. You're just responsible for that 5% incremental loss. Does that sound fairly accurate for what we're describing? Yeah. All right.
Spot on. Hit the nail on the head.
Dallan, any other comments on that or questions?
I'm impressed.
Don't be impressed.
So I do have a question. So we talk a lot about that. These are defined outcome periods, right? We're saying here's what you can expect. If it's a 1 year, and we're in July, so tomorrow's July 1st. So you can expect from July 1st to June 30th. Here's the cap, and here's the buffer that you're protected on, right? This isn't maybe unique to the dual directional to a lot of your products.
Yeah.
How should people? It's like, oh, I'm not at the beginning of an outcome period. It's July 15th, and this thing came out July 1st.
Yeah.
I guess I'm just gonna have to wait till the next one comes out,
Great
right?
question.
Or can they look at it and evaluate whether they want to participate in the current one?
Yeah, that's a very good question, Dallan. The first thing I would say for people that are listening is consult a financial professional, groups similar to you two, as far as how to navigate, because the whole, we have well over 100 tickers here at Innovator, and they're all at different points in their outcome period, but they all are trading on the exchange. So you can go out and buy any of those things today. Now, we always urge caution to know what you're investing in before you invest. That's why it's important to consult a financial professional. But the short answer to your question, Dallan, is yes, you can buy into these at any point. Now, what's different is what your defined outcome is. All right. If we listed a regular buffer ETF on July 1st and today's July 15th and the market's gone up 5% in these last 2 weeks and the ETF is up 3%, well, what was originally a 13% cap, call it, because the fund has used up 3% of that, now is only 10% that you still have remaining on the upside. But more importantly, now we've created what we call a downside before buffer. The buffer starts back where it was on July 1st. So if you bought it on July 15th, up 3%, now we can lose that before the protection kicks in. And so that's why most people are buying these at the beginning of the term. That's why Innovator has such a wide lineup, where if you miss out this month and you want to wait for the first day of a new outcome period, well, great. We have new ones coming out in August, and then we'll have some in September and then in October, but we use tools available for you at your disposal. For clients, for retail advisors, or retail investors, we usually say work with a financial professional. For financial professionals, consult groups like us. Make sure, work with the resources you have. Hey, you both have seen them on our website. We have great tools that can show you, here's your upside, here's your downside, if you looked at it today on July 15th versus where it was at on July 1st.
Right. And Dallan and I have access to a lot of these different companies like yours, and I'm not sure if our tools are different than the typical client-facing, just investor, non-financial advisor website.
Mm-hmm.
I know almost every website now you go into, probably everyone, they say, are you an investor? Are you a financial advisor? Are you a blah, blah, blah? Are you, do you fly around with wings? I don't know. But we have access, and we can go and look at these and say, hey, does it make sense to buy this particular one or this other one now that we're in the middle of an outcome period, or just not day one? Maybe it's day two, maybe it's day 300. What does that look like, right? Because the goal of each different buffer ETF is from the beginning of the outcome period to the end of the outcome period. You buy it in the middle or any time in between there. It could be different, and typically will be, because markets have moved somewhat up or down. So it's going to change your cap. It's going to change your downside protection level. So Dallan and I look at that as we go through our portfolios, and we encourage everybody out there, to the extent that you can, to do that. Definitely. Or to talk to your advisor about that. So,
and you may have said it, Jack, so I apologize. On the dual directional ETFs, will you be coming out with monthly versions here at the beginning, or will it be a quarterly?
Good question. We're going to start out with quarterly. So we'll have these July versions that run from July to July. And then in October, we'll have the October versions. But back when we started doing the first buffers in 2018, we started with those quarterly, and demand quickly dictated for us to go monthly. So we'll see. Feedback for these dual directionals has been very encouraging up until this point. And so if enough people like them, and clients like them, then we'll probably shift our focus, hopefully, to a monthly launch schedule. But at the time being, we're planning for quarterly moving forward.
Okay, thanks.
Yeah, and what I've seen in the industry, and tell me where I'm wrong or add any color that you'd like. You start in the beginning, build it and they will come type deal from the movie, and people came. And so you can build more, right? You don't just want an ETF with $100,000 in assets and then you go out and build the next one. You wait until you reach some size, and then you're like, hey, let's go from quarterly to monthly. Let's go from monthly to offering these weekly. Let's offer a buffer of buffers where we can get in there and manage and control, right? So you have profitability in mind. You got to have the size. And as the industry and people and advisors and clients want them, then that's why you're seeing more companies jump into the space. You're seeing more offerings.
Yeah, you're exactly right, Mike. I think, listing ETFs in general is expensive. And so to just dig right in and just say, we're listing, 12 of these 15% buffers every month. And then with the 10, that's 24 additions to our lineup. And I think you said it perfectly. I mean, there's just got to be interest there for us to go that route. And hopefully we hope there will be. And so we'll see how these July versions and October versions come. And then we'll probably, the nice thing about being, a younger company is we're pretty nimble. We can make the shift on a as need basis to be able to list more of these products.
And I haven't seen any buffered ETFs close, but I have seen a lot of other ETFs out there that get into a certain space, a certain niche, and they just can't attract the assets. And 6 months, 12 months, 2 years later, they're closed, right? Because you got to have enough assets in them. So I think that speaks well for the kind of the space and the demand there.
Absolutely.
No doubt.
All right, so we will wrap up with this episode of the Buffered ETF Guys, and join us for the next episode. We are going to be talking about BALT. We'll describe that in the next episode. Hope y'all have an incredible and blessed day.
Take care, everybody.
We hope you enjoyed this episode of the Buffered ETF Guys. Please hit that subscribe button so you never miss an episode, and share this podcast with someone who could benefit from it. Check out our blogs, webinars, and other resources at atxfinancialplanning.com. You can easily book a meeting with an advisor at ATX Financial Planning at atxfinancialplanning.com. That's atxfinancialplanning.com. We're headquartered in Austin, but we serve clients from coast to coast. Be on the lookout for our next episode. Stay wealthy by protecting your wealth. All content is for information purposes only and should not be relied upon as individual advice. Investing always involves risk and possible loss of capital. All opinions expressed herein are solely the opinions of the person making them. Participants and clients of ATX Financial Planning and guests of this podcast may maintain positions in the securities discussed in this podcast. Talk to your advisor before acting on anything. Nothing mentioned on this podcast, including specific investments mentioned, should be taken as a recommendation. Advisory services are offered through ATX Financial Planning, LLC, an SEC-registered investment advisor.